Welcome back. I'm your money mentor, Andrew, and I'm so glad that you're back today to learn about investing. So, what is it? Realistically, investing is just putting money away for your future. It can be in a high interest savings account, it can be in stocks, it can be in crypto or precious metals, anything like that. It's basically thinking about what your future will look like and making sure that you're preparing for it as best as you can. Now, the value of investing can be that you're trying to earn extra money on top of your money. So rather than it just sitting there as a lump sum of money, it can be earning you extra on top. The reason why we want to do this is because over time, inflation can erode the purchasing power of our dollar. If you look at, let's say, a chocolate bar from the 1980s, it would have been a lot cheaper than what it is today. I remember when I was a kid, you could get quite a large block of Cadbury chocolate, and that was the family block, and it would cost you $5. That was a typical price just without a sale. These days, you're spending $8 for the little tiny block, and it's basically you're paying a lot more money and you're getting a lot less for your money. And that's inflation in a nutshell. It's basically the devaluing of your dollar. It's that year after year it can buy less. So hopefully with investing we can try and retain a bit of that value of our money. How do I invest if I'm under 18? Long story short, if you want to invest if you're under 18, you're going to need a parent or a guarantor or someone to sign for you, some sort of guardian. They basically create an account in their name, and all the investments will be held and managed by them. You can still have input, obviously, and it's always a fantastic idea for young people to learn about investing from a young age. But it's more just the management side of it to make sure that it's all handled correctly. It needs to be done by a responsible adult. So what happens here is basically you have a trust account that you set up, and you can do it through accounts such as CommSec, for example, Commonwealth Bank. That's an Australian bank account. For any Americans, you might look at I don't know, maybe Goldman Sachs, Wells Fargo, something like that, I'm assuming, because they're quite large banks. Our top four banks in Australia are NAB, ANZ, Westpac, and Commonwealth Bank. So all of those have their own trading platforms. Where can a beginner start investing? Investing can start simply as just micro investments. There are micro investing applications like Raise or Comset Pocket or other accounts. You may have something like even eToro or something like that might do smaller trades on your behalf, sort of thing. I've seen how they've got a copycat trader function. I haven't looked quite into that. I don't know how much I would trust other people on the internet investing for me. It's not really for you, but it's basically you're copying what they're doing. So I don't think that would be the best choice. I think it's always best seeing a financial advisor and getting proper financial advice, or just learning yourself as you go and doing your own research. Things like Raise, the way that they work is on a rounds up system. So when you connect your bank card to it, for example, you go out shopping, spend some money on a packet of chips or your groceries or petrol, whatever it is, and it'll just round up to the nearest dollar, something like that. And that extra money that it's rounded up will be put automatically into your investment account and reinvested for you. You want to keep in mind what your costs are. So if your costs to actually invest the money on your behalf is going to cost more than what you're earning, you're going to be in a deficit. So essentially you're losing money on investing. That can be how some of these applications like Raise work, where it may not actually be worthwhile for you to invest. But if you check it out and actually do a bit of the maths behind it to see how much money you need in the account to turn a profit, then you can kind of work from there. But it's always best to be mindful with these applications and checking the fees associated before you actually dig into them. Different bank offerings. So CommSec, NAB Trade, there's a few others on the Australian market. American market, like we said before, Wells Fargo and Goldman Sachs, things like that. The larger banks, I'm sure they've all got their own investment platforms. I'll show you shortly what our one looks like for CommSec, for example. It's quite an easy platform to use, and it's our native Australian platform. They basically hold shares in your name. So it's what we call a CHESS sponsorship. CHESS means you have your holder identification number, which is specifically under your name. Your shares that you purchase are automatically placed under your name, under your CHESS sponsorship, and it is yours. You hold on to them. No one else can touch them, basically. The benefit of this is that it is 100% in your name. They are your shares. There's nothing to worry about. It's all written in contracts, essentially. There are other platforms that you can use, for example, Robinhood, eToro, Webull, Moomoo, all these sorts of things are not CHESS sponsored. What that means is basically they're going to buy a whole bunch of shares in, let's say, Apple, Google, anything else like that. And when you buy it off of them, you're buying technically a holding of it, but it's not in your name. So they're going to hold a cumulative pile of stocks, and you are just going to technically have a stake in that pool, but it will not be in your name, which is one thing that you do want to be wary of, because if the company does go under, that could actually handicap you, and it may cause issues. So let's dig into opening an account. All right, so right here, let's go into Google and we'll type in CommSec. If you're not too sure, so what I'm going to do is make sure that as we're going through any of our lessons, I might just talk through what I think of when I do these things, just so everyone can get a clear idea. If I had no clue about CommSec or anything else, and I'm like, oh my God, which platform should I use? I could just go onto the internet and type in investment accounts, for example. Okay, so we have, you want to be careful with this. So up here is the sponsored results. These ones are paid for. That's not necessarily the best. It's just who's put the most money into marketing their product. Okay. Top thing is CommBank. Okay, so clearly CommBank is a well-used and well-trusted company, as they're at the top. Next thing is moneysmart.gov.au, which shows you a bit of information background, and that could actually help you in getting started. Next one is Vanguard Australia. Generally, Vanguard provides ETF options, which we'll get to in another video. But in short, ETFs is basically they'll buy a whole bunch of companies, say 200 companies, and they'll sell you a small portion of each company for a set price, whatever it is. Okay. So if we're going to use CommBank for today, for example, that is their CommSec app. So if we click on CommSec, on their main page, it'll just have a nice big yellow button that says sign up. Pretty simple. You just follow the steps one by one. Are you already a customer? If you are a customer, great. You probably already know the process. If you don't, if you're not a customer, we click no. If you're a CommBank customer, do you have a NetBank client ID number? If you are, you can click yes. If you don't, we click no. Select which account you'd like to open, whatever suits you best. Okay, I'm just an individual, so I would click individual account and next. Things to know before you start. So all applicants must be over 18 and you'll need to provide the information below. You'll need personal details, so you'll need an ID, maybe a passport or something like that, driver's license, Australian residential and postal address, so just where you're living, a valid email address to receive your application. It's always good to make sure that you have a reliable, safe email address that you can receive all of your information to, especially if you have it connected to your investments. One day, if that's worth a lot of money, your investment portfolio, it can be very helpful making sure you've got that. A current mobile number and tax residency information. So if you're an Australian citizen, perfect, simple enough. You just tick Australian citizen. If you're not, then you just go through whatever their steps are for that. Step number 2. So a Commonwealth Direct Investment Account, CDIA, will be opened alongside with your share account. This manages your funds. Basically, a CDIA account is a bank account separate from your investment account. So when you buy shares, that's on your investment account, and then that comes over to your bank account and it takes money from it. Okay, so you need to make sure that you put money into the CDIA account. Then when you buy your shares, it can come along and take some of that money out to fund your shares that you've purchased. There are always fees associated when you are buying stocks, unfortunately, but that's just the nature of it. You know, they're providing a service, so they're going to make their money. So with CommSec, you can trade online from $5. So for trades valued up to and including $1,000, it's $5. Okay, so if you're buying $5 of stock, then it's going to cost you $5 as a fee to basically conduct that trade on your behalf. So you need to double your money, make a 100% return before you even break even. So that's not going to be worth it unless it's an extremely risky stock, and just wouldn't be worth it. But if you're investing, say, $500, okay, $5 is only a small portion. You could quite easily make that return back. If you're investing $1,000, it's not very hard at all to make that $5 back. So I always do, for myself, try to invest $1,000 when I can, so that $5 fee is quite minimal. Next step up, so it's $10 over $1,000. So even if it's $1,001, it will cost you $10 fee. So you may as well drop the amount of stock you're buying by a couple of dollars, get it under that 1,000 so that you're only paying the $5 fee. And up to and inclusive of $3,000, it's $10 trading. Over $3,000 and up to $10,000, it's $19.95, and there onward, it's just more and more. For your CDIA account, you'll need your tax residency information. So if you're an Australian citizen again, just put in that information. You'll also need your tax file number or exemption code if applicable. Anyway, so we click continue, put in our details. So I can be a doctor for today because I'm a doctor of money. I'm male. My name is Andrew. Okay, we put in our last name. There we go. And then you can put in your date of birth. Go with that one. That's not my actual date of birth. I don't know why that's popping up, but we'll use that. Residential address. So I'm going to pop in a random one. 82 First Street. Let's see. Yep, South Australia. That's where I live. We click next, and then you put in your email and stuff, your mobile number. I'm just gonna bleep that out, and then continue on from there. And then so after you've put in your email address, you put in your phone number, and then you click next. Again, just continuing on the steps, and you'll get to the end of the process. Once you've got your account set up and you'll have an email sent to you, it'll have your client ID number and everything. Then we can go into CommSec. We can log in. We can put in our client ID, and we can put in our password and log in. Okay, this is what your main page will look like. Starting from the top and working our way down. So you've got your home page. If you ever get stuck, just click that home button and it'll bring you right back here. Your portfolio is probably the main area you're going to be interested in. And just for a little bit of assuming maybe some of you have done some of this before, I've purchased a couple of shares over the last couple months just to make this a little bit more relevant to some of us. So currently what we have is a few shares valued at a couple $1,000s in the account. We have our CDIA account connected, which has $1,000 in it, ready for our next investment. And if we click holdings right there, it shows us what we actually hold. Okay, so right now we have DTEC, which is a defense ETF. Our purchase price was $18 about, and it's now at about $19.50. So we've made from a $1,000 investment a profit of about $78. So that's not bad so far. Our others haven't been so fantastic. Ingham's, if you don't know, is a number one a number one seller of chicken in Australia and number 2 in New Zealand. So they're quite large over here. They sell to McDonald's, Kentucky, Coles, Woolworths, pretty much all the chicken that you see throughout Australia. A lot of it is coming from Inghams, so they're quite a large producer. We purchased at what I thought was a fair price. They've gone even cheaper, which is the reality of the share market. You will be purchasing things at what you might deem is a reasonable price, and it may still drop even lower, which there's not a problem with at all. That's just the nature of the game. Sometimes they go up, sometimes they go down, and no one will be able to predict the market, which leads me into a key point. If anybody ever says to you, I know a stock that's going to go up 100%, you're going to get rich on this, it's a blatant lie. Don't listen to that person. They're lying to you. If they tell you you can get rich off something quick, it is a lie. Okay? Ignore that person. Walk away from that person. They're just trying to steal your money. Okay? So our next one that we're looking at, Treasury Wine Estates. That one we bought for $5 and a little bit. It was trading at about $11, $12, so it's about 50% off. It's gone a bit further down. Okay. That could also be a better opportunity to buy in even lower, or it could kind of start to spell its demise. One thing that you need to keep in mind is throughout economic factors, like right now, we have a bit of a situation with Iran and the US and other countries being involved. And that, isn't a fantastic scenario when we're investing in a premium wine company, right? Because the last thing that people are going to want while there's civil unrest in the world is to drink fancy wine, okay? But with that said, could be a good entry point in the future when things start to return back to normal. We bought in at a decent price and we might make some good money in return. So that's where the logic is behind that. Our next company is Zip. Zip, for those of you that don't know, is a buy now, pay later company. It essentially is kind of like Afterpay. It's almost exactly like Afterpay. So it's a company that was around $12 during the whole COVID period, just afterwards, because there was a lot of money inflow. People were spending. They had a lot of money left over from standing around at home, working from home, not actually going on holidays and spending money on quite large purchases. So what they would do is just use the buy now, pay later, pay in four or whatever the product is that they were utilizing, and just pay that off over time as they go. And so that's what your portfolio will look like. If we go into watch lists, it'll show up with different companies. You can add stocks to your watch lists by clicking this button here, typing in a company. For example, if I go WTC, which is WiseTech, then I can click this little plus here and it will add it in. So I've set up a couple here. So 2026, I've put a few different stocks in that I'm interested in at the moment. 2026 tech. These are a couple others that I'm quite interested in, but these are more tech focused companies that haven't done so well lately. Next section is quotes and research. You can type in any company that you want. So if you want to type in, for example, Woolworths, then we can have a look at their data a little bit. We can see what their prices are looking like. So last price was $35.29. We can see the highs and the lows for the day, what they were, the 52 weeks, so for the whole year, what the highs and lows were. So it's quite close to where the high is. And the low was quite a bit lower. So it was right back down here around October. With your chart, if you click on the button here, you can change the time, basically, whether it's a 1 year chart, 10-year chart, 5-year chart, it's up to you. Seeing where it was in the past and having a look at where it can go in the future. Mind you, bear in mind, what it's done in the past does not mean that's what it's going to do in the future, okay? Statistics and data can help give us a bit of an idea and guide us, but it will not be a definite answer, okay? So if something has done amazing in the past, that doesn't mean that's what it's going to do in the future. Perfect example, APX, is Appen. Appen was a market darling, which basically means they were fantastic. Everyone was so excited for them, and look what happened. Okay, so they were trading above $30 per share, and then all of a sudden a huge drop. This was partly COVID. This was partly Google releasing their contracts with them, and this was also partly starting to go into the fears of AI being overhyped. So everyone moved their money from AI, partly being Appen based, into other companies. And now as people are starting to pull their money out of it because of fears, they've also been pulling it out of Appen. So that's not been doing very well. Okay, so always keep in mind that a stock can drop. Next one for trading. So this is where you can go if you want to buy or sell a stock. This is a more complicated way. I wouldn't get a beginner to do it, but you can do it here. So if you know what you want to do, let's say you want to buy. If I want to buy Woolworths, it's WOW. And you can check who's buying at what price. So this person's buying at $35. This seller is selling at $35.30. You can put in how many you want to buy, or for example, a price that you want to buy. So let's say $1,000. Market order means it'll give it to you at the best price that they can. Limit order means I want to pick the price, which I recommend most people doing. $35.15 is halfway in between the buy and sell price. So that's a pretty fair price, I would say. Good till expiry is until you cancel the order, or I believe after a certain amount of time, whether it's a week or a month or something, it'll cancel. Otherwise, good for a day is just for 1 day. And then it'll tell you down the bottom how much you need to pay. You can click review order and then put it through. If you're buying between 10 a.m. to, let's say, 4:30 p.m. On the Australian market, you should be fine to get your order in and complete it, as long as it's at a reasonable price. Anytime outside of that, so right now it's about 9 p.m. If you're buying stocks at 9 p.m., it'll be the next day that it will go through, okay? So until that time, you'll have all night to cancel the order or amend the order if you change your mind. So next, we'll go back onto the home page. So looking a bit further down, if you've had any purchases that you need to settle, they'll be shown up here. So it'll basically tell you how much money you need to pay. On the other side, credits will tell you how much money you are going to be paid into your account. So if you have dividends coming through or something, it may show up there as a credit for you. Down here, you've got your view holdings, which is basically the same as your portfolio. That's what you own. Your watch lists, so what you're keeping an eye on. Recommendations is this here, I'll show you. It's pretty much showing what is recommended as a buy, a strong buy, a hold, a sell. These are coming from companies that are basically putting a recommendation on it. Okay, so you might have Morningstar, for example, say that this company is a strong buy because of what their data predicts. Okay, so they may think that due to a company's earnings and everything, it's undervalued or it's overvalued, so it'll give you a rough idea. I don't necessarily recommend buying your stocks just because you see something says strong buy. Still, probably always best to see a financial advisor to get proper financial advice. But that also can just be a bit of a guide. Next one, managing orders. Okay, so if you've already put in an order, you can come here to outstanding orders. It'll show it up below and you can cancel it, amend it, do whatever you want to do. Placing an order, buy, sell, putting in your quantities and stuff. Again, this is a slightly more complicated way. I'll show you the easiest way in a moment. And confirmation, so down here it'll tell you the different things that you've purchased. Okay. So how do I buy? How do I invest? To actually invest, let's say you've picked a stock, okay, and we're going to do this in my next video, which you'll be able to see at the same time as I'm posting this. So what I'm going to be doing is setting up a Trade With Me series of videos where we invest together. I'm going to be losing my money, not you guys, so you guys can learn new things about investing. I will learn new things about investing and we can do it together, okay? The benefit of this is you don't need to put your money at risk, okay? Keep it safe. This whole purpose of this channel is to be educational. I'm willing to put my money on the line just so that we can all learn something new together, okay? Again, see a financial advisor before you do your investing and make sure you do your own research and due diligence. But just so you can see the process, this is how we're going to be doing it. So in our next video, we're going to be investing in Woodside. This is the price that it's currently sitting at. If we look at the chart for the past 10 years, so there's been some peaks. It's had a bit of a drop off at times, come back up again. So around here was about COVID sort of time. So it did have a bit of a drop off. That very well was probably partly because everyone was at home. There was no one driving around, no one catching airplanes going anywhere. So the price of oil just absolutely dropped. Currently, with the whole situation in Iran, we're having an opposite situation where the oil prices are going exponentially higher. And the longer the war goes on, who knows how high oil prices can go. So that's my logic behind this purchase. I think it could be a good long-term buy. Now, if we have a look, so recommendations, so 4th of March 2026, so that's quite recent. Fair value $42, so it is 30% higher. This one here, $36, and this consensus over here had 2 strong buys, 4 moderate buys, 7 holds, 1 moderate sell, 1 strong sell. So these are just ideas from companies where they think this stock is valued. If we go to the fundamentals down here, market capitalization. This is substantially more important than a share price. For example, if I have Woodside worth $30, for example, and then I compare that to, say, the share price for Google. Let me open up an extra tab here. So if I go here and I type in GOG, is it? No. GOOG, sorry, my bad. So this is worth $300 for Google, okay? Now Google's market cap is going to be substantially higher. It does not actually say. That's a bit silly. Okay, well, we can just type it in. Google market cap. Okay, 3.7 trillion US dollars, and it's worth $300 per share. Whereas if I go here, it's $30 per share and a $60 billion company. To go from $60 billion all the way up to 3.7 trillion would make this $30 price tag so much more than $300, okay? The way that you get a price for a company is by having, where are we? Does this say? This doesn't say the amount of stocks. So what is market cap? Market cap in a nutshell is basically how many shares you have in a company. Let's say it's 1,000 shares in a company or 100,000 shares in a company times by the share price. Okay, so if everyone, let's say 10 million people have one stock of this company we're looking at right now, which is Woodside Energy, then it would be whatever that amount of stock is times by whatever they're willing to pay. If it's $10, then that amount of stock times $10 is your total market cap. Whereas for a new stock, if you have a brand new startup, it might be valued at, I don't know, $100,000. Okay, so if it's a one owner company, one stock is $100,000 because one person owns the entire company. If they decide to sell it and they say 100,000 stocks, 100,000 shares of the company, and they're all worth $1 each, then that company's worth $100,000 still. If they have 200,000 shares worth 50 cents each, then that company is still worth $100,000. They're just more shares valued at a cheaper price per share. Okay. Market cap is just a blunt number. It's just the value of the company. Okay, so don't get tripped up by looking at the stock price of a company, because it could be worth peanuts. It could be worth $1,000, but just have so few shares that the stock price looks high and it's not really worth anything. So having a $60 billion market cap, that's a lot of money. Yeah, it's not million. Okay, 59 million can disappear very quickly. 59 billion with a B will last a long time, even if they're bleeding into their money. That's a pretty good market cap behind the company. And to get to that amount, it means they would have had good management. So hopefully they've got some free cash flow on the side, so that if there are any areas that they can invest in to improve their profits, then they'll be able to take advantage. Next one, PE ratio. This is also fantastic to look at. So PE ratio is basically saying how much did we earn in the year, and if we earned that every single year, how many years would it take for us to buy our own company back? So 15 is a pretty good number. Let's say anywhere between 10 to 25, pretty decent. Okay, you're probably looking at a larger company if it's in that ballpark. Something like Woodside is 15, something like Microsoft at the moment is about 25, and that's quite a large company. The difference is with Microsoft, it's a tech company. They're still growing, so 25 could actually be quite a good, reasonable price company if that's where the PE ratio is sitting at, because in the future there might be a lot of growth, especially with AI, so there might be a lot more earnings in the future down the track. Another company that I've seen with quite a low PE lately is Qantas, which is pretty much an airline that Australia is very proud to have, and it's kind of like our mascot up in the air whenever you see that kangaroo on the side of the plane. Their PE ratio is 8, so pretty much if I bought the entire company today, it would take me 8 years, as long as it's earning the same amount and not, bleeding into their money. It would take me 8 years to earn back my money. Okay, so that's a pretty good return, assuming it stays the same. Part of the reason it could have dropped is, again, with the situation in Iran, they may not be flying very much, so they may lose money over the next couple years, depending how long it lasts. Next thing, dividend yield. Basically, companies, once they get to a certain size, they're going to start saying, I want to start paying my customers. So here's X amount of money. They may give you a percentage based on what the stock price is worth. So Woodside Petroleum is $30 per share. Our dividend is sitting at 4%. Sorry about that. And yeah, that's what you would get per annum. So they may pay just one dividend per year, or they may pay 2 dividends per year. You're not getting 4% twice if you're getting paid twice per year. You're getting half of the 4% each time. So you get 2% dividend, then 2% dividend. So this is the total amount for the whole year. Dividend stability is how often they pay it out. So a higher percentage means that they're not missing any of their dividend payments. And ex-dividend date and pay date. So your first one, ex-dividend date, is when they record it. You have to own the stock before the ex-dividend date to actually be eligible for the dividend. And on the pay date, that's when they actually pay you out. Keep in mind, not every stock pays a dividend. It's nice to have, and if you're looking to earn an income, then that's probably what you're looking for. But it's not necessary, because you can have some fantastic growth-based companies where instead of paying a dividend, they reinvest the money back into the company to try and grow it larger. That's basically how it's done. So setting up the account, checking out your investments. One thing that I do want to throw in there quickly before we head off, if you go into Quotes and Research and into your find and filter stocks, it'll give you a stock screener. You can click down here, where are we? Add more criteria. So you can click market cap, for example, and you might want a large market cap for the company that you're looking to buy. You might want a specific sector. So let's say you like healthcare, you want something that's going to help people, because that's part of investing as well, is knowing what do you want to invest in. Is it going to be something that's going to help people? Is it going to be something that's around the future, technology, energy, anything like that? It's always good to know what you want to invest in. And also, a good idea that I've been following in the past and have been happy doing for myself is just investing in things that I like. I really like the idea of cryptocurrency, and I've used it. So I invest in that, which I know a lot of people don't and are a bit weary of. But besides that, I invested in Ingham's, for example. I like tendies. You got to have a chicken tendy. It's nice. So why not invest in it? I like wine. Why not invest in Treasury Wine Estate? Buy now, pay later. I haven't really used, but I've got friends that have used it. They liked it. They thought it went well. I don't have a international trading account at the moment, but I will do a video on how to set one up. And when we do, I'm going to be investing in Coca-Cola, for example, because I quite like that. But looking here for the moment, so we just put in a couple criteria. We put in a large market cap, so it's going to be quite a big company. And the good thing about a big company is that it's not going to go under easily, because it's got a lot of money behind it, and a lot of assets that it could at any point sell and use that money to try and catch itself when it's struggling. Healthcare, and then if we have a look at these, so you've got Sonic, you have Sigma Healthcare, ResMed, Ramsay, ProMedicus, Fisher Paykel, CSL, and Cochlear. So Cochlear, let's just click on this as a quick look. This is a company that creates hearing aids and other devices so that you can help people with their hearing, and that's had quite a large drop off lately. I would dare say most of that is partly because of the whole AI race I don't think that's going to be a long-lasting thing. But with that said, that comment could age really poorly, so it could end up just seeing Cochlear not perform at all. With that said, being such a large company and being such a crucial player in people's lives and just, helping people have better quality of life, that's a company that I personally would like to invest in, because I like the idea of supporting companies that provide items like hearing aids to help people have a better quality of life. That's a moral side of investing, and using ethics to kind of guide where you want to invest. All right, so that's investing in a nutshell. That video was a lot longer than I thought it was going to be, but I hope I got most of the information down and made it as clear as I could. If you have any other questions, just drop them in the comments below. If you'd like to subscribe, that would really help me out. And we're going to be doing videos on a whole range of things investing. It's going to be all of the basics, as well as an invest with me, where we go through it together, and we check through our portfolio together. And then I will also be putting out just a few other videos that are my own personal thoughts, and just slightly more advanced techniques. I wouldn't say advanced necessarily, as I'm still learning to get there myself, but more intermediate, I would say. So if you have already gone through the beginner stage and you do want to learn a little bit extra, I'll guide you through that path as well, and we'll learn that together. All right. So I hope you guys found some part of this video today valuable, and I'll see you next time. See ya.
The information provided in this video is for educational, informational, and entertainment purposes only, and does not constitute financial, investment, tax, or legal advice. I'm not a licensed financial advisor, tax professional, or attorney. The content is based on personal opinions, experiences, and research, and is not intended as a substitute for professional advice. Investing involves risk, including the potential loss of principal. You're solely responsible for your own financial decisions. Always conduct your own due diligence and consult a qualified professional before making financial decisions.